NDAS 113 Fair Value of Measurement. NDAS 113 applies when another NDAs requires or permit fair value measurement or disclosure about a fair value measurement. And the instrument such fair value less cost to supply based on the fair value and disclosure about about this measurement, except in specific circumstances. What is trying to say? So only applies when other NDAs permit for fair value measurement. It can't be applied in and whenever. Only when it is required, it will be applying. And that should be permitted by other NDAs for applying NDAs 113 fair value measurement. The measurement and disclosure requirement of NDA is not applied to following. This NDAs doesn't apply to share-based payment, lease, inventory, impairment of asset. For this specific cases, it won't apply. Share-based payment transaction, fair value of measurement doesn't apply. What is the actual to be done? Lease transaction with the scope of NDAs. Lease transaction is usually fair value measurement can't be done. It is as per the NDAs 116 lease measurement should be taken. Principal and interest fair value is not there. Measurement have some similar to fair value but not fair values. Net realizable under NDAs 2. NDAs 2 inventory concept lower or fair value whichever is lesser. Cost or fair value whichever is lesser. Sometimes the fair value may not completely apply there. Value in case of India is 136. Impairment of assets. Some assets can be used to be removed from it. So in that case, fair value of measurement you can't apply. These are the place India is measurement and disclosure of fair value of measurement can't be applied. Disclosure requirement in DAs are not required the following. The plan assets measured at fair value as per Ind AS 19. Employee benefit it does not apply. Asset for which recoverable amount of fair value is less cost to disposal as per Ind AS 36. There also you can't apply. The standard defines fair value as the price that would be received to sell an asset or pay to transfer a liability in orderly transaction between market participation at the measured date. In this date, in that market, if you want to sell, what will be the price we can recover after recovering all the cost to sell, everything is being subtracted, what is the measure? That is mean as a fair value. Assets and liability. The fair value measurement is for particular assets or particular liability. Therefore, when measuring fair value, an entity shall take into account of characteristics of assets and or liability. If the market participant would take those characteristics into account, then the price of the asset or price of the liability are measured at the date. Then such characters include condition and location of the asset and restriction, if any, sale of usage of asset. So the asset and liability is a particular asset and liability. What's the fair value? Should say then. The measuring the fair value taken into account of the asset is taken into its characters. What is the asset? What is the liability? What is a character to be accounted for this asset and liability? On this date, on a specific date, what will be the conditions? Example, this asset to be sold, it should be processed. The asset should be sold, it should be packed. The asset should be sold, it should be removed from the place. Asset to be sold, it should be gone to this remote location. Asset to be sold, this certificates to be gotten. Asset to be sold, this approval to be required to be got from the management. These kind of results also to be considered before considering the fair value. A transaction, the fair value measurement assumes that assets and liabilities exchange in orderly transaction between market participation to sell the asset or transfer the liability in the measured date and the current market condition. So transaction is that as transaction means exchange for what? Money for the goods. On what date? On a measured date. What measured date? Within 10 days, 15 days, that is in the current market, not future market, in the current market. in the same condition. It's not a proper, it's not processed condition. On the same condition, it should be there. The fair value measurement assumes that transaction to sell the asset or transaction to transfer the liability takes place either in the principal market for the assets and liability or in absence of the principal market in most advantageous market for assets and liability. The transaction should also say which principal market is going to take place or auxiliary market will takes place. And this transfer should be taken place either in the principal market or any other principal market, any other market. It taken place. That is a, if that taken place, it is a transaction. And if it takes place in this market, what will be the price we recover? That's also we should see. Market participants. The entity shall measure the fair value of asset or fair value of liability using assumption that market participant would use when price of the assets or liability or assuming that market participant act in the best economic interest. To see why always participants should not influence the market. It should be fair value. Likewise, it should not be gone the price. The goods should be sold in a very fair value. It should not be sold in a underpriced or overpriced. The normal market participant will be there at that market. If the goods is being sold, a liability is discount. What would the price or what is the asset or what are the liabilities discharged? What will be the possibility? That is the participant, this is a condition, the price. Fair value of price that would be received to sell the asset or pay to transfer the liability in orderly transaction in the principal market, most advantageous market at the measured date and the current market condition that is exit price, regardless whether the price is directly observable or estimated using other valuation techniques. So the goods should be sold in the specific in orderly fashion in the principal market, and the market price participants should be fair participants, and it should be sold in exit price at the same time. It should be directly observable and it can be done by any valuation technique. It's not an issue, but there should be a proper valuable price. Application to non-financial asset. The fair value measured of a non-financial asset taken into account for market participant ability to generate economic benefit by using asset in the highest or best use or by selling to another market participant that would use the asset in the highest and best use. Highest and best use of the non-financial asset taken into the account the use of the asset that is physically possible and legally permissible and financially feasible. To the main point, what I'm saying is to see whether the asset is be sold. Now, it's physically possible. Can go with the asset and go to second legally permissible. We can't sell something it is illegal. Second, financially feasible. Right now, can we have the resources to sell this asset by incurring such cost? And this price what we quoting, it's possible for the buyer to buy or sell it to the close of the liability. Is that possible? Such things also should see when and applicable to the non-financial asset. Something a non-financial asset to be sold, it be economically feasible. Na? We can sell something without any use. It is a valuation technique. The valuation technique used to measure the fair value shall maximize the use of relevant observable input and minimize the use of unobservable input. So when we valuing something, it should be value based on the input available, observable input, and we should minimize the use of non-observable input. Sometimes a company will value the product um, not using some technique which is not feasibly they will use. They will bring into the cost that even not there. Sometimes they will bring into the gain which is it's not economically feasible cost they will bring in. They will overvalue the asset, or sometimes they will undervalue the asset. That should not be there. Market approach and cost approach. Valuation techniques that use the prices, other relevant information generated by the market transaction involves identical or a comparable asset or liability, a group of asset, a group of liability. That's a business. In market approach, we want to sell this car. We have a car. So same car in principal market and in this time, what is the price is going on, what if you can see visible transaction or a group of this car has been sold, na, then that is the price of the market approach. Cost approach is a valuation technique that reflects the amount that would be required currently to replace the service capacity of the asset referred in the current replacement cost. So we can able to sell it, sir. Okay. Then we can buy the same asset now. You go to the market. You say, I want a second-hand car to buy. The same car. You go to the market and see what is the price they are offering. And that cost minus 10% or 15% of the profit margin because they will always say commission is usually there. 15% commission margin after you will see this is the price they want to sell it. So you want to buy it, so reduce the 15% commission, and this is the cost. It is a cost approach, a valuation. Income approach. Income approach, the valuation techniques is convert the future amount of cash flow or income or expenses to a single current, a discounted amount. The fair value measured is determined on the basis of the value indicated by the current market expectation about the future amount. This income amount is, we will see. So this asset, if we have with us for next 5 years, because the asset useful life is 5 years. So what will be the income it will generate? Make it the present value or the interest rate FD provided by the bank. And the interest rate, what is the present value of the future income usual? That will be the income approach. The valuation technique used to measure the fair value shall maximize the use of observable, relevant observable input and minimize the use of unobservable unit. So whatever the value technique we use, that brings value approach. Not only it uses the maximize the observable unit and use the unobservable input. Sometimes some unobservable input we don't need to. We can minimize that. To increase the consistency and comparable with the value measurement and related disclosure, India has established a fair value hierarchy that consists of three categories. The input of valuation techniques used to measure the fair value. To get the value, it's not overvalued, undervalued. They are approaching three input level, or just in hierarchy level. Fair value hierarchy gives highest priority to quoted price, unadjusted active market for identical asset or liability level 1, and lowest priority to unobservable input level 3. So level 1, level 2, level 3 inputs. Unquoted price, and it is an active market for identical asset and identical liability. Asset is accessed at the measured date. So today I want to sell this price, a quoted price. You go and give what is the quote for the asset. They say this is the quote. That is quoted and active market price. That is a level 1 price, level 2 price. Input other than a quoted price included within level 1. It's observable for the assets and liability either directly or indirectly. I'm not able to quote a price over that. So I'm saying, "Oh, I want to purchase this, some other method I'm using, but it's somewhat linked to quoted price. But it's not an unquoted price. Then it's level 2. Level 3 input is unobservable input for the asset and liability. I don't know. There is no one is there to give a quote. So I'm bringing into some assumptions based upon my working and my research. I'm saying this is that is a level 3 disclosure. The entity shall disclose information that helps the user of the financial statement assess both the following. So entity should disclose. That is a disclosure main clause. What to disclose? Asset and liability that are measured at fair value on recurring and non-recurring basis. Based on the balance sheet after initial recognition, the valuation technique and input you use to develop this measure. So what is the method we are using? What is the value is being, how the value is being obtained, and what is the input for this valuation also we should give. Second, recurring level of measurement using significant unobservable input level 3. Sometimes we may use input level 3 to value because we don't have the input 1 and input quoted price. And the effect of measurement on the profit and loss or other comprehensive income for this period. So in that case, we may need to recognize the income and or a loss in other comprehensive income for that period. We should also make sure this is and disclose it. This is the other comprehensive income and it's a level 3 input, and this is the reason for this level 3. because the reason there is no product is available for valuation, that is also be disclosed. Thank you.